You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glen Sarvati.
Welcome to another edition of the Big Cast. My name is Glen Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And we are back from America's Credit Union's Government Affairs Conference that took place in Washington, D.C. The last week. Let's see, what was that? I guess March 2nd through 5th, if I'm not mistaken. And we've had our annual conversation after the economics team from America's Credit Unions was on stage giving their outlook for the U.S. economy and its impact on credit unions. They were gracious enough to sit down and talk with us. So we'll be joining that interview in just a couple minutes. And before then, let me just remind you, you can find out more about the Best Innovation Group by checking out our website, big-fintech.com. You'll find past episodes of the Bigcast there under the Media tab. You'll also find lots of information about the various products offered by the Best Innovation Group, including help on artificial intelligence, API connectivity, etc., etc. You'll also find our link to our old blogs as well, and a new blog too. So much to cover here. We've got so much that was going on at GAC, as I'm sure you're aware. 6,000 plus people attended. That was the third consecutive year that they set an attendance record. And I have to say, I thought there was an added level of energy this year. I doubt that's too big of a surprise, given the changeover in administrations in Washington and the uncertainty that has created, that I'm sure had people a lot more curious about everything going on. And frankly, the phrase existential threat came up more than once. So I think engagement in terms of a sense of urgency was absolutely kind of front and center. We've got a lot more to talk about on that than we have time for here. And like I say, this is the first of our two episodes. We have some other interviews next week we'll be covering that we captured over at the Government Affairs Conference as well. But you can also find out more about that. I'll be writing up a blog that goes into a little bit more detail on a few of the topics we're not going to hit here. And also some additional deep dives on the topics we are getting to with the economics team. You'll find that. I'll post a link in our show notes to the episode, but you can also find it at the big-fintech.com website. You can also find out more if you join us on our CU Town Hall, which takes place more or less bi-weekly on Wednesday afternoons, 3 p.m. Eastern, noon Pacific. And this week, we're going to be focusing on basically a debrief on the Government Affairs Conference. We'll have several people there who were on the town hall who were at GAC and can share their impressions. And I'd like to think it's at least as valuable to the people who were not there. You can ask questions and kind of just hear what we picked up on a variety of topics around Interchange, the CFPB, the NCUA, and the tax exemption, which is the biggest thing that I think is out there right now to talk about. So you can find out more about that by checking out cutownhall.com. You can ask for an invitation to the town hall if you'd like to join us live, which I recommend. And if you're hearing this a little bit too late, that again was taking place or is taking place on Wednesday, March 12th. If you're hearing this after that date, go out to cutownhall.com anyway, and you can listen to a replay of that as well. As I mentioned, existential threat, tax exemption, that was the single biggest topic, I believe, at the Government Affairs Conference. As you're probably aware, as the government goes through cost cutting and finding ways to fund an extension of the 2017 tax cuts, one of the things that seems to be on the table is the long-standing tax exempt status of credit unions. That is a scary thing and was referred to, as I say, more than once as an existential threat. CEO of America's Credit Unions, Jim Nussle, pointed out that 50% of the members of Congress have turned over since that 2017 tax bill was approved. So it's a matter of re-educating a whole bunch of people again. And the disturbing thing to a lot of viewers at the conference is it is expected to be a far less transparent process this time around than it was when passed in 2017, where people have to go on the record in terms of saying what they're approving of and disapproving of and having debate, etc. But this, because it's being taken care of through a budget reconciliation process, it is much more prone to a 2 a.m. back office deal which frankly was the way that the Illinois Interchange law got passed, which we've spoken about and will be speaking about again relative to some of the conversation at at the Government Affairs Conference. So there is definitely work to be done, and it was done as the conference ended with members hiking the hill, as they call it, going out to the various constituencies of their state governments and speaking to the elected officials, making sure that the voice of the credit union was taken into consideration. On a more positive note, Jim Nussel did point out that credit unions were born in an era of disruption back in in the wake of the Great Depression. So, I think we have a role to play here as well, and it's just a matter of that message being properly deployed to the elected officials so that they fully understand exactly what the value proposition is, which is the whole point of the conversation we're going to be having here with the economics team. Normally, it's a pretty pure economics update in terms of a forecast for the coming year. This ain't the year for a nice, clear, concise forecast with all the different variables and uncertainties that are out there, as you can imagine. And given the issue around tax-exempt status, that was a big focus of the conversation. The case of why the value of that tax exemption is one of the better returns on investment you're going to find in terms of government policy. If there was any question about what the focus was going to be, the economics team came out onto stage to the tune Taxman by the Beatles, and then focus, I'd say, the majority of their conversation around those cases. So we'll be covering that as well as a broader view of tariffs, economic outlook, and as you'll hear, a rapidly changing environment that changed in real time as they were on stage and has changed yet again since they've been on stage. With no further ado, I'll let them introduce themselves, but the four members of America's Credit Union's economics team. Here for our annual check-in at GAC with the economics team from America's Credit Unions. Just got off stage doing the economists update as opposed to the economic update, right? Mike Shank, Kurt Long, Lee Givada, and Dewey Kabede. Interesting stuff as always. I know you actually had an added mission today on the Don't Tax My Credit Union, really kind of reaffirming why it's important, the credit union difference. But we always talk about the outlook from an economic standpoint as well. Why don't we flip the script from the way you did it on stage and talk about generally, I think, the update from a forecast standpoint, probably an awful lot of unknowns, I think we can say. But on a baseline standpoint, a slight improvement from 2024. Is that a fair way of stating it, the way your forecast was? No?
Define improvement.
I mean, most of the metrics seem to be going in the right direction.
Well, coming into the year, we were forecasting, was it 3 or 4 rate cuts?
True.
Right? And now we have one.
Our final forecast of 2024, that's right. And then our most recent one was from January, and we only had a single rate cut because that was in recognition of that bounce that we've seen in inflation towards the end of 2024.
And again, I think you've mentioned that the forecast does not incorporate the current uncertainty around tariffs. And this may change again by the time we're actually playing this out. But while you were on stage, I saw the alert come through that tariffs are going into effect tonight. Now, whether that holds beyond tonight, who the heck knows? But that is not baked into your core forecast, as I understand it.
It is not. And it will be very impactful if the trajectory is what it seems to be for a bunch of different reasons. These folks probably have more of a perspective, but the thing that rises to the top, I think, which is a really big deal from an economic perspective, is what might be happening with cars.
Yeah.
And,
that and auto lending
and auto lending by extension, but just the cost of cars, we already see big increases in used car prices. And to the extent that in the manufacturing process, we have multiple steps in that process where things are going back and forth across the borders from the United States to Canada, from the United States to Mexico, and then back, and then back.
Until I heard you say that, I hadn't really, that every single one of those back and forths is a separate tariff taxable event, I take it? I mean,
well, I guess the devil's in the details,
exactly.
I guess, but that's how it would work in my brain.
Unless it's one of those, oh, that's not what we meant, and we can kind of rework it. Exactly.
On the impact of tariffs is what the Congressional Budget Office put together. Just assuming, for example, a 10% tariff increase on, on Chinese import. 10% across the board increase, 25% on China. That, and then the impact was, there is going to be, I think, a 1 percentage point increase in inflation, and then, increase in unemployment rate, and also decrease in economic activity. But the thing is, and it keeps changing, right? So the rate changes. First, there is another tariff, and then a counter tariff, which makes it really difficult to, fine tune that estimate. Which is why, when we get into this meeting, it's very hard, to take this into account, because we don't know the extent of the final policy action.
I would say this has got to be about the most difficult environment to ever forecast a 12-month outlook, because there are just so many different variables that are beyond just kind of in flux. They're just totally thrown into the air with no idea which way they're going. And
obviously, one variable that's virtually impossible to estimate is what would happen to confidence and how people would just react from that standpoint.
Yeah.
Doesn't take much to shift that, and it happens quickly, and it could spell trouble for the economy.
And it's, an awfully big hand wave, but taking all of those unknowns off the table, what I meant to say in terms of the forecast, I believe the baseline forecast has loan growth ticking up slightly, deposit growth ticking up slightly, delinquencies, I think you used the phrase, the worst is kind of in the rearview mirror, maybe actually coming down a little bit, but all of that could change at the drop of a hat, I guess, with everything else going on, right?
Yeah, I think that's right. I think the way I see it is I could still stay with sort of that baseline forecast that we had as the most likely in the wide range of possible outcomes. Mm-hmm. But I think the risks are shifting day by day to more of a downside, more of those downside possibilities. And in a broader sense, I just see the radar is up. We're looking all the time for evidence that some of these things are kind of taking root, and some of the macroeconomic indicators are starting to erode. Really haven't seen that yet, but of course there's a lag on those indicators. So it may be coming, but we just haven't seen those yet. But I think it's fair to say that the economy is on shakier footing than it was, 6 weeks ago, 3 months ago, or whatever. So it's going to take less and less to tip the economy. When we get to that tipping point, whatever it is that sends us over the edge, it's not going to take as big of a shove to get us there, right?
That's a really interesting, good way of thinking about it. That makes a lot of sense. Gina, I thought we were starting on the upbeat side of the conversation. It didn't really work out that way, because Mike, when you came up on stage talking about, and again, you started with the whole taxation issue, you used the phrase existential threat, and you look more animated than I'm used to seeing you about. This is truly a significant issue that you think is a message that has to get out there. So can you say a bit about where we stand relative to the advocacy point and how we can actually defend our position?
I think in general, the main reason we're especially concerned is that the process this time is different than the process in the past. And Carrie discussed this, I think, in her remarks.
Carrie Hunt, the head of advocacy.
In her remarks, in the past, we've had the opportunity to weigh in at the committee level, and that doesn't seem like it's going to be a possibility.
And this is because it's going through the budget reconciliation process, and It's just a detail deep in the line items and
smoke-filled back rooms kind of thing, right? Maybe not smoke-filled, but you get the idea. It'll be happening in the absence of our ability to sort of jump in and provide context or objections or feedback in any way, shape, or form, I think.
And hence the need to get the message out before you get to those, before people retreat to the back rooms.
And I meant to make the point that we have a lot of new policymakers up on the Hill, not simply reps, but staffers that conceivably don't know anything about the credit union difference, may not even know what a credit union is. So the really important thing is that we get ahead of the bankers and inform them on that stuff and avoid a situation where the bankers are telling our story.
And, again, one of the myth-buster approaches you took was the whole notion of credit unions don't pay taxes. And you quoted some numbers. No, well, we're talking about one very specific kind of taxes, but you mentioned payroll taxes, property taxes. I think the number kind of came out to, $12 billion, I think?
Yep.
Yeah, $12 billion in direct taxes. And of course, credit unions are also employers. They also work with vendors. So their interactions with those groups also generate taxes from those parties as well. So yeah, it's just simply not the case that credit unions don't pay taxes, but that's the message that a lot of times it gets out there from the bankers.
And that $12 billion is offset against $3 billion, which is, I guess, the foregone tax number if you actually face taxes on credit union quote unquote profits for a not-for-profit.
Right. That's the estimate.
Yeah. And that compares to, I think the other number that was put out was in the last year, fiscal year ending in September this past year, of $37 billion of financial benefits generated. So a pretty good cost-benefit analysis.
Yeah, that's right. So we got a great question from the audience about what would happen if credit unions did go away, and that's sort of those are the stakes, right? And so at the bottom, bottom line, this is a public policy question, and to me, the evidence is just very clear that this is a great investment. It's great public policy, and to initiate a tax would be just a terrible mistake.
Lizzie, you showed me a really interesting chart as well. When we talk about, where those, benefits come from, historically, it was in the form of lower rates on lending. But there's been a very significant uptick recently just because of the change in the rate environment, where it's also really become almost equally important in terms of the higher deposit rates and yields that members receive.
Yes, in fact, historically, lower interest rates on loans was the factor driving financial benefits of credit unions. But over the past 2 or 3 years, I think in 2021, when interest rates started to go up, we saw a shift to higher yields. And in fact, I've written papers or answered interview questions that ask me, why are savings yields higher in credit unions? So it is widely recognized that credit unions do pay higher saving yields, and the data shows it.
And you've got a new dashboard that's actually going through this stuff, disaggregated on a state-by-state basis, et cetera. But it was striking the extent, if you can look just basically back to COVID, like 2021 or so, the extent to which the curve just goes straight upwards in terms of the savings, in terms of the yield that people receive on their deposits.
Yes, that's right. And right now, both of these factors are kind of contributing half and half to financial benefits.
Which in the past, it was like 12, literally like almost,
million,
3/4, 1/4 or something like that.
Mm-hmm.
And
the other interesting thing, I think, Glenn, is that the graphics that Dawit showed made it very clear that while we can talk about the benefits in the aggregate, that we see in the detailed data, in that Equifax data, and I'll let you describe it, Dawit, but within the auto portfolio and in the mortgage portfolio, the folks that benefit the most when we think of financial benefits are really people of modest means, people on the lower rungs of the credit score ladder. What do you see in that data, Dawit?
Yeah, that's correct. So this data just looks at the originations, loan originations, across different credit score profiles. So we are able to see that, and we are able to calculate the interest rate at origination for autos and mortgages, and then we calculate the life of loan savings for autos, that's 6-year term auto loan and 30-year first mortgage loan, based on those credit interest rate differences. So what you see is, the same story in both loan types is that people at the lower end of the credit score spectrum save the most because those are the ones that are charged the highest interest rate at banks. The difference in interest rate for those people is sometimes cannot be explained by the risk they pose in terms of loan repayment. So this is a proof that credit unions provide people of modest means, where people that are struggling financially save the most.
But give them a little context in terms of the absolute savings for the folks.
So the value of the savings. Yeah. So for auto loan, deep subprime borrowers are able to save around $11,000 over 6 years, and assuming they take out $40,000 loan. Yeah. And mortgage borrowers, as you see, assuming a $225,000 loan, they save about $40,000. And actually, this is the lowest that we saw this year. If you go back to 2020, 2022, we've seen savings as high as $70,000 over 30 years.
This is the kind of message that's got to get out. And I know you've mentioned before, I know this, we've spoken about this, I guess it's going back 2 years now when you first acquired this Equifax database. Yeah. And I know, Mike, you and I, and you've mentioned this, you didn't exactly know how it was going to be used, but you knew it was a wealth of data. And that's, Luigi, I know you're talking about that tomorrow on a separate session. You've got the dashboards being set up, and you've got the direct kind of ability to quantifiably, to confirm where the quote-unquote credit union difference is. Another thing that I'd never heard before that, and again, kind of putting the lie to this whole notion of the tax exemption, is subchapter S banks. And I guess, as I understood it, 1 out of every 3 banks in the U.S. is roughly a subchapter S. I mean, I guess that means it has less than 10 shareholders, and therefore, basically, I think that was what you said, Mike. That's the definition, or the criteria. Less than 100. Sorry, yeah. But because of that, if you have a subchapter S designation, it's a pass through. Basically, it's kind of like a credit union. That's 1 out of every 3 banks.
Yeah, that's right. So there is this large population of banks with a tax advantaged situation, and of course that doesn't get out there in the discourse probably as much as it should, even in spite of how much we introduce it. But yeah, so there are all these subchapter S banks, and the interesting thing is that these have become a focal point of academic research recently. So there's a number of different studies that have looked at the way that these subchapter S banks are handling that tax benefit. What are they doing with it? We know on the credit union side what's happening, which is that credit unions are passing that benefit along to their members in the form of better rates and lower fees. On the subchapter S side, they find no difference between the rates that they offer and the rates that your standard C Corp, large banks offer. So the bottom line is that those tax benefits are getting pocketed
by the less than 100 shareholders.
That's right.
Yeah. And another point that you made that I thought was interesting, because it came up, another objection is this whole notion of credit unions acquiring banks, which was a whopping 22, I believe, that were even announced. I'm not sure they even all were finalized last year. You had another really interesting statistic about, okay, if the idea is community ownership, that may be a better alternative. I think it was 2/3 of the assets in terms of bank-on-bank mergers were actually coming from large banks out of state.
That's right. And that is it turns out, a really important thing to the bank, to the board of the bank who is merging out. And so we actually conducted a survey, and it turned out that local ownership was an extremely important factor for these banks that are, entering these transactions, looking at the different.
You're saying the ones that credit unions are acquiring.
That's right.
So that's a factor in favor of selling to a credit union as opposed to an out-of-state bank.
That's right. So they find with a credit union a more common culture. They find an institution that is more likely to retain the branches. We talked about how quickly bank branches are going away. They're going to retain the branches in that local community. They're going to retain the staff, right? And those are all, it turns out, very important things to that board of directors that is considering, a buyer.
And it's never made sense to me. It's like, if you are selling a bank, it would just make natural sense that, obviously if you have civic pride and you want to have it locally owned, but at the end of the day, from a pure economic standpoint, the more buyers, the better. And that's going to be, maximizing your return on your exit strategy.
Yeah, that's right. So I think this is one of those things where there is that disconnect between community banks and what they truly want and their trade associations and what they are the message that they're pushing out there.
And that was another thing that you mentioned also in the presentation in terms of even the community banks and where they perceive their competition to come from. When they speak to their regulators, and the statistics bear out the competition is coming from the big banks, not from the credit unions. And credit unions have been kind of bopping along at the same 9% or so deposit share. I forget how far back that chart goes. It goes back a while. It's at least, early 2000s.
Yeah, that's right. And, another thing is that, when you compare the lines of business, credit unions and community banks, in a lot of cases, they don't line up. I mean, community banks are really heavy business lenders, right?
Yeah, exactly. When we think community bank, I think we still have this like Jimmy Stewart, like It's a Wonderful Life in our heads. But the ones, especially the newer startups, tend to be there to make commercial and industrial lending.
That's right.
Which is important. Not saying it's not important.
That's right. No, it is. And C&I lending, commercial real estate is a huge, it's probably the single biggest line item in the loan portfolio for community banks. And, these are obviously for reasons that we're all familiar with, not areas that credit unions tend to be as heavy in. And that imbalance has only gotten, more so as you were saying. In these surveys, community banks are identifying large banks as becoming bigger factors, competitive factors in these areas.
Yeah,
and just to set the record straight, Jimmy Stewart ran the mutually owned building and loan. It was Potter that ran the bank.
Good point. Point. Thank you. That's it's not, the money's not in the safe. The money's in his house. But this is fascinating stuff as always. And, I'm sure the story will change multiple times before we get to the finish line. But anything else on the existential threat, Mike, as you put it, and any other key kind of takeaways, myth-busting kind of things that we want to make sure kind of get on the record here that people can consider?
The one thing that we didn't cover, which is very important. Now, we already talked about the 92, almost monopoly market share that they have, right? 92% of all assets.
And of that, it's like about 65 is sitting in the biggest banks, right? It's the share that's been eroding has been the smaller banks, and it's all being lost to the big banks, not to the credit unions.
Almost all, yeah. The banks, the credit unions have gone from about a 6% market share to 8, almost 9, over that 35-year period. So, the vast majority of the pain and suffering, if you want to think of it that way, is attributable to big banks.
And as you've said before, also, or at least you said on stage, that is not exactly pain and suffering. The community banks are actually doing quite well.
They're doing quite well. They're actually out earning their larger brethren, and their growth rates are actually fairly high in the scheme of things. So, but the one thing I did want to bring up is the notion that one of the things that matters when we look at structural differences, yes, it includes things like giving people money back instead of giving it to shareholders, but as a for-profit, you have quarterly earning calls. If you're a public company, you have quarterly earning calls, and you're under intense pressure to deliver larger and larger dividends to your shareholders. And that sort of incentive structure basically causes bankers to take outsized risks. We've seen it all the time historically. A lot of examples of this. Now, they're not always the exact same risks. They kind of jump around in terms of what they're selling, basically.
It's always the black swan. You don't see it coming, or you avoid it.
So, you see them trying to increase profits during the Great Recession, the lead up to the Great Recession, the financial crisis. They were abusing people on the lower rungs of the credit score ladder. Very obviously, previous to that point in time, about 5% of bank originations went to subprime borrowers. Leading into 2007, that 5% went up to about 25%. So you could see it in that data. We see the same thing today in the automobile lending data using the Equifax data set that David has looked into. Very substantial focus on subprime borrowers. Not unusual to see rates around 30% for some of the deep subprime paper.
Wow.
And what would the median be? Somewhere in the neighborhood of 20 or something? 17, 18.
And to your point, I mean, the greater savings are accruing to the lower rungs of the economic ladder. So what?
I mean, you can hear in individual stories say people paying 36% for auto loan. That's
right.
Yeah, that's.
And I mean, we've kind of gotten accustomed to 20+% on credit card loans.
Yeah.
But auto loans, which have some pretty hard collateral against them too, that's
right.
pretty remarkable.
So another thing we've found in our data is that, I mean, average matters. So we usually look at average interest rates and how credit unions, offer lower interest rates for loans. But we're also looking at the variability. And what we find is that interest rates are not only lower on average, but also the variability is lower for credit unions. So really what reflects is that we are a more stable, solid option for consumers. And in consequence, delinquency rates are lower for credit unions, but they're also more stable throughout the business cycle. So we have great evidence, a lot of data that proves this, that credit union members are more financially resilient than non-members. And this is true across credit scores, geographically, across products too.
I think that was, David, I think that was another slide that you showed, that it was transactors are always lower in terms of delinquencies and late payments than revolvers. But then if you look at revolvers and transactors, the credit union members were the lower in terms of delinquencies and late payments than their bank equivalents. And I found that to be pretty interesting, which says something, I don't think it's a self-selection process of who joins a credit union. I think it has to do with the credit union's approach to the way they're making their loans, I would think.
Yeah. So this is a dynamic view of looking at, who is, under stress and who is not. Because like most of the data that we have that, for example, credit score models or utilization rates are usually a moment in time snapshots, right? So lenders are starting to use these trended data, just looking at, it's just not just the utilization rate. So because some super prime borrowers are using cards like to pay for stuff, and then they may have, high utilization rate, but they pay it off immediately. Does that person pose the same risk to the lender than the person that keeps revolving it throughout time? Which is why it's very important, to show this, even though it's available for credit unions at individual level, to show it movement-wide how this looks like. And that's what that slide is about.
As I think you all know from past years, I could talk about this stuff forever, but we should probably wrap it up. But there's great information. I mean, at the America's Credit Union website. I mean, I don't know if this deck itself, but I know you put out videos. Is it a quarterly basis, monthly basis? How do you communicate?
We do monthly videos. Whenever we come out with a new forecast, those are typically posted on the website, and almost always we will do an economic update video describing the process and the results of that forecast. The other thing that's really important, I think, for people to know is that as a dues-based membership organization, we are providing them with resources with the dashboards that help them not only with advocacy, but very soon they will have access on our website to dashboards that really dive into operational issues like delinquency rates and things like automobile lending, the trends in that market. Soon after that, hopefully mortgage lending, some really good data at the state level at the moment, but we have the opportunity to go a little bit lower.
The aspiration to go,
yes,
like you said, zip code, the sample size can be a little bit too small to be comfortable with, but
so especially in an environment like this where there's a lot of uncertainty, to be able to see what peer credit unions are experiencing and how they're behaving, and then what your competitors in the for-profit sector, whether they're banks or auto finance companies or mortgage banks, how they're behaving, what kind of loans they're making. Super helpful to know.
Well, I'll definitely be following up. I know, Elijah, you've got this session. I'll be very interested in more of the dashboard work. And obviously, and Dawood, I know you're diving in with the Equifax. Want to follow up on that too. And we'll post a couple links to the more recent economic updates that are available out there on the website. Kurt Long, Elijah Votto, Dawood Kabede, Mike Shank, thanks so much. Always enjoy this conversation. So as we talked about, of many, many uncertainties out there that are floating around is the tariff whipsaw effect going on. It was kind of amazing that I was sitting there watching their presentation, talking about the extent to which tariffs were, or more precisely, weren't included in their baseline forecast that the America's Credit Union's economists had put together. And there we go. Literally, while they were on stage, I started getting texts from some colleagues saying, look at this, the tariffs are going into effect tonight. And then 2 days later, the tariffs got pulled back again. And now they seem to be coming back again. So depending on when you're listening to this, it may have turned back and forth again another 3 or 4 times. The other thing that is often said, markets hate uncertainty. And as I'm recording this on Monday afternoon, March 10th, I think it's pretty clear that markets are not real crazy about the uncertainty if you've seen what's going on. As I said, lots of interesting stuff, far more than we can discuss. I want to keep this as brief as possible so you can make sure that you join us again and don't spend too much time listening to our weekly podcasts. But if you check out the blog, and I will have a link to that, as I said, posted in the show notes, which you can find at the Best Innovation Group website or wherever you're listening to this. If you're listening on Spotify, Apple Music, Amazon, etc., you should be able to click through to that. We'll have a blog that gets into some of the other hot topics that we discussed at the conference around the future of the CFPB, what can be expected from the NCUA over the course of the next year. Not only the fact that there's still that conversation, at this point I'd say more of a rumor than anything else, of a look at regulatory consolidation that could go as far as to have the NCUA and FDIC folded into the same entity and possibly both being tucked in under the Treasury Department or something like that. So we'll jump into that. But again, if you look at the blog, and also state level interchange, which is a big one and is really a precursor probably to federal level interchange and the Credit Card Competition Act, the latest on those topics that we've also been talking about for some time. Check that out in the blog. And as I said before, cutownhall.com. March 12th, if you want to join us live, we'll have some more lively conversation about those topics as well. A couple of other things that just jumped out at me that we've talked about already and we'll cover in the blog. I thought it was really interesting when you talk about the whole notion of credit unions acquiring banks. Another way of looking at that is 2/3 of all bank-to-bank mergers, the acquirer is an out-of-state bank. So which is a bigger problem, an in-state community-based credit union keeping a continuity of service locally, or an out-of-state entity coming in and absorbing a community organization? I think my point is clear. I'll let you make your decision on that one yourself. The other one that I had not heard before, but I thought was really interesting, is the notion of subchapter S corporation banks, which according to the economists are roughly about 1/3 of all banks in the United States. Well, guess what? They don't get taxed at the corporate level. Sounds a little like credit unions. So I'm not exactly sure what the big fuss is about there in terms of the, not exactly the same thing, but close enough that the terminology around, the credit unions aren't taxed, as you also heard in the interview with Kurt and Mike and the rest of the economists, was there's more taxes being paid. They're paying far more than the quote unquote exemption that's out there. And one of the other things that is a little bit concerning, especially as we start hearing a little bit more rumblings about potential of recession, credit union members are more likely to be impacted by downturns. And the information that DeWitt shared with us as far as going through, the members who are receiving the biggest benefits in terms of rate differentials from credit unions compared to other options in terms of lending and deposits, tends to accrue to folks at the lower ends of the economic spectrum. Something else to consider when we think about this stuff. With that, let's wrap up this episode of The Big Cast. As I said, we'll have more from the Government Affairs Conference next week. So please do, if you're not already in the habit of checking back in with us on a regular basis, would certainly appreciate if you do that. We tend to have new content every Tuesday afternoon, and you can always find it at the Best Innovation Group website, big-fintech.com. You can also find us at all your usual places that you may be picking up podcasts, Spotify, Apple Music, Amazon, etc. And if you like, subscribe, whatever they ask you to do over there, you'll get an alert, as I do every week whenever this goes live. And I've got several people who immediately wind up contacting me and saying, "Oh, didn't expect to hear this one this time," but always appreciate the feedback. And if you have anything you'd like to share with us, John Best, our grand poobah here, please do drop a note. We'd love to hear from you. Also, you can check out our last week's episode where John shared his ideas for creating a Bluesky server for a moderated opportunity, a communication hub for the credit union community, which I think is a great idea and something that we'll be spending some more time looking into. As I said, big-fintech.com is the place you can find our past episodes or more about the company itself. We'll be back next week. We'll be back on the town hall. And as always, thanks for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big Fintech. Email info@big-fintech.com. Or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.